Hi, namaste.
Hello and welcome back to another episode of InsurePulse.
In the previous episode, we spoke about what happens when payments stop completely and how disruptive that can be for a business.
Today we want to talk about something most businesses deal with far more often, which is payments that don't fail outright, but keep getting delayed, especially in B2B transactions.
Exactly. And that is where the trade credit insurance is often misunderstood because people tend to think of it only in the context of insolvency or outright default.
Whereas in reality, it becomes relevant much earlier, when delays start turning into a pattern and cash flow pressure begins to build quietly.
Yes, 45 days becomes 60,
Mhm.
60 stretches into 90, and suddenly businesses find themselves juggling liquidity.
Yes.
That's true. But here's the gap. A contract can define timelines. They can't ensure that money actually comes in on time.
And you see this very clearly in sectors like logistics and supply chain services.
Now, think about a logistics firm with stable contracts, predictable volumes, and long standing client relationships, where services are delivered on time and invoices are raised exactly as agreed.
There are no disputes, no quality issues, nothing that would normally trigger concern.
Yes, yet payments keep getting pushed out.
Every follow up sounds reasonable. Accounts is processing it, approvals are pending, the next cycle should clear things.
Individually, none of that raises alarm bells, which is why it often gets tolerated for longer than it should.
But over time, the pressure starts to show. Fuel costs don't wait, salaries don't wait, vendor payments don't wait.
And even a profitable business can find itself managing day to day liquidity stress simply because receivables aren't coming in on time.
This is where trade credit insurance starts to matter in a very practical sense. Not just a claims product, but as a way to protect cash flow when delays become persistent.
It gives businesses a buffer and the confidence to keep operating without constantly firefighting overdue invoices.
And once exports enter the picture, the complexity increases even further.
Because at that point, payment delays aren't always linked to buyer behavior or operational issues.
Absolutely. Sometimes they are driven by decisions completely outside the transaction itself.
Now, you remember that case with an Indian textile exporter who was shipping a bulk order worth about $120,000 to a buyer in an African market? And by all normal measures,
Yeah.
it was a solid transaction.
Yes, the buyer was solvent, the relationship was established, and there were no issues around pricing, quality, or delivery.
Exactly. Everything about the deal looked sound until something entirely outside the exporter's control changed.
The local government imposed a foreign exchange ban, which meant US dollars could no longer leave the country.
So even though the buyer wanted to pay, they simply couldn't move the funds.
Yes, and this is where many exporters get caught off guard because it's not a commercial failure, it's a sovereign decision.
Yes. In this case, the exporter had opted for political risk insurance as an extension to their trade credit insurance cover.
Yes, that allowed the insurer to recognize the currency inconvertibility as a valid political event.
As a result, 95% of the invoice value was reimbursed.
Oh, that outcome mattered because the exporter didn't have to absorb a loss caused by a government decision they had no control over.
Exactly. More importantly, it meant one country's policy shift didn't derail their broader export strategy.
Yes, and this really brings us back to the point about trade credit insurance.
It's not about assuming buyers will fail.
It's about recognizing that payment risk shows up in many forms: delayed payments, liquidity stress, regulatory gaps, and political decisions.
And that risk often appears long before an actual default takes place.
Trade credit insurance helps businesses manage that gray zone between a delay and a default, especially in a market where waiting beyond 45 days has quietly become normal. And if you're looking at trade credit insurance as a way to protect cash flow, manage receivables, and continue trading with confidence, particularly when payments stretch beyond agreed timelines, it's worth understanding how it fits into your overall risk approach.
You can explore this further at www.mahindrainsurancebrokers.com.
That's all for today's episode.
Until next time.
Take care.